Adrian Day, president of Adrian Day Asset Management and portfolio manager of the Euro Pacific Gold Fund, joins us today to discuss what happened today with the FOMC meeting. Adrian, welcome to the show. Welcome back. Happy Fed Day.
Yeah, thank you for having me, David.
All right, let's play what Jerome Powell announced earlier today, and we'll react together.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Do you agree with today's decision, first and foremost, and then we'll discuss details?
Well, yeah, I mean, I don't think anyone was, well, first of all, I don't think anyone was surprised that they didn't cut rates. They shouldn't have been surprised, although some of the markets seemed to be moving ahead of it, indicating they thought there would be a cut. But I don't think anyone really was surprised at that. And no, I'm not sure I do agree. I'm not sure I do agree. I don't. I don't know if you want me to expand. It was interesting. One of the most interesting things in what was, for the most part, a very uninteresting press conference was when Powell admitted that, if anything, we were a little late in our last rate cut. Now, when they started cutting rates back in, what was that? Oh gosh, I've forgotten now, September. If he thinks they might have been a little late cutting then, I can only say that they're being very late cutting now. I mean, Powell kept saying, we don't know what's going to happen. There's a lot of uncertainty, policy, government policy can change, all of which is absolutely true. But he was repeatedly asked about, shipping from China and different economic indicators and statistics and anecdotes, and kept saying, well, but it's not reflected in the data yet. And this is my biggest criticism of the Fed. They are, in being data dependent, as they keep telling us they are reactive. And this was very, very clear from Jerome Powell today. They are reacting rather than being proactive and getting ahead of anything. Okay, so he can look at certain statistics and say that a slowdown isn't showing in the data yet. But I mean, we know how many ships are leaving Shanghai. That's known. We know how long ships take to get from Shanghai to Los Angeles. That's known. We know that companies and businesses around the country have been telling us for the last 2 weeks that they are cutting spending, but they are reducing expansions. Wynn Casinos today said they were stopping all of their CapEx projects, including a revamp of the Tower Suites that was about to start. Well, we know that. These are real hard data. And yes, it hasn't shown up yet in the aggregate data that they look at, but these things take time. When Wynn stops its expansion, well, it goes to its contractors next, and the contractors start scratching their head saying, what do we do now? Do we stop other projects we're on? Do we lay off people? Do we get a line of credit from the bank? I mean, all this stuff takes time. But I will put it this way. We know the direction of travel. It's pretty clear that the economy is slowing. And even if President Trump came out tomorrow morning and said, just joking about tariffs, forget about it all, I don't think we'd be back to square one. And so to me, if the Fed thinks they were slow, or maybe slow, I should say, a little late in cutting rates in September, I think it was September,
Yeah.
then surely they should have cut rates now.
Well, hang on. The stock market is pricing in some positive news. Stocks rise as Powell says the economy is holding up. Assurances by Powell that the economy remains sound and the Federal Reserve won't be forced into a rash action by Donald Trump's trade war bolstered markets. This is what he had to say about tariffs. This is what Powell said about tariffs. Take a listen.
The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent.
He's acknowledging that things could get worse, but the markets are somehow interpreting this as good news. He's not saying it will happen, but how are you interpreting what was just played for you?
Yeah, well, look, for once in my life, I actually have a tiny little bit of sympathy for the Fed chairman. And he's, of course, absolutely right that there's an awful lot of uncertainty. There's an awful lot of uncertainty right now that will affect the economy and affect labor markets and inflation. And he's absolutely right that their role in this is a lot less than it has been in the past. I mean, they're not driving the bus. President Trump and his administration is driving the bus at the moment. So I do have a little bit of sympathy. And yes, things are certainly very uncertain at the moment. But to me, it's also clear that the economy has been slowing. We've talked about this before, slowly, but there's signs that the economy has been slowing, even before the tariff wars came in. Yeah, I mean, if we wait and see, a month from now, it may be too late. I would also say it's also questionable if the impact of tariffs on the economy is the most important thing we're looking at, and people were talking about empty shelves and supply chains and so on. It's a little bit unclear to me what a cut in interest rates would actually do to solve that.
If I offered you a $100 bill, but you had to pay me $115 for it, would you take that deal? Of course not. But that's exactly what happens when you purchase gold and silver and high dealer markups at significant costs to each purchase. Well, that's where today's sponsor comes in. Today's sponsor, Bullion Standard Pro, is a membership-based platform providing direct access to wholesale pricing on precious metals. The same pricing dealers and retailers pay, like Costco, for example, except for gold, but without the 40-pound Mayo jars. By aggregating live market maker bid-ask product data, it offers real-time pricing with significantly lower spreads compared to traditional retail markups. For context, traditional dealer spreads on popular bullion products can exceed 23%. With Bullion Standard Pro, these spreads can drop as low as 2.1%, offering you a cost-effective way to buy and sell precious metals. How much can you save? Hundreds, if not thousands of dollars on a single order, depending on the order size, of course. So to learn more, visit bullionstandard.com/pro and use the promo code DavidLin. Your first month of membership is free, with no commitment required. Link down below or scan the QR code here to get started. Invest smarter now. Right. That was my kind of question to myself last night. Even if I asked myself, even if Trump were to even if Powell were to cut rates today, right, by 25 basis points, what would that do? How would that assuage consumers' fears of heightened geopolitical tensions? How would that assuage consumers' fears of heightened higher prices at the grocery stores because of tariffs? Right? It's not like people are going to all of a sudden start spending more because the Fed funds rate is 0.25% lower.
No, of course not. And that was my point as well. But I mean, I do think lower rates would help. If I'm a small business with a line of credit with a variable interest rate, and my contract with the wind, my contract just gets canceled, I'm sitting there puzzling, how am I going to keep all my employees on because I'm loyal to my employees? How am I going to keep these all on? And then my interest payments on my line of credit go down. That gives me a little bit of breathing room, and multiply that, of course, by the millions of small businesses around the world.
Mhm.
I think it's helpful, but it's not helpful in an immediate sense.
Let's take a look at some more market movements. This is the dollar DXY shot up today post 2 p.m. Eastern
Yep.
time. What happened with the dollar and subsequently gold fell on the news? We'll talk about gold in just a minute, but dollar first.
Well, I think the dollar was up because with Powell ruling out an interest rate now, which was not unexpected, but with ruling out the interest rate or not doing an interest rate cut now, and being even I would say a little bit cautious on suggesting that there might be an interest rate next month when other central banks around the world are cutting. Then the interest rate differential, the comparative interest rate differential starts to favor the dollar. So I don't think this was so much, I don't think this was a reflection simply of what Powell said. It was a reflection of what Powell said in the context of what other major central banks are doing.
Okay. Do you think that the dollar is now on an upward trajectory from just Fed policy alone? Keep in mind that the dollar has been sliding all year round. This is zooming out. The DXY has not had a good run since the beginning of 2025, which surprised many people, including myself, because tariffs have historically been bullish for the dollar.
Yeah. No, that's right. I think it was a reflection both of, as you say, Fed policy, but also a reflection of uncertainty, even chaos, if you like, in the US. And also, as we know, we'll talk about this in a second, I'm sure, but the pending debt refinance crisis, if that's not too strong a word, that is coming later in the year. So, I mean, yeah, I wasn't surprised that the dollar fell. I think I was perhaps surprised it fell quite as much as it has this year without any kind of retreat, with any kind of correction. So I think a correction now is certainly in the cards. It's certainly, a strong possibility, probability, but I don't see it going back to where we started the year.
Okay. Are you optimistic on risk assets, including stocks, right now?
I think in the near term, the stock market is going to be strong. There is so much, I mean, the sentiment, the money on the sidelines, all of that still favors stocks. And remember, so much of the money pouring into the stock market is automatic. It's 401ks that get, money added every month, and that money goes into, ETFs, and most of that money goes into S&P ETFs. But I think fundament. My approach to the stock market right now is to be we're still long, but to be very cautious and to be really looking for the exits. And I would rather be out early than out late.
Okay.
Because the other thing we must remember is not only are the flows into the stock market from 401ks and so on automatic, but you also have the same phenomenon globally. If you go to Britain or Europe, the money is flowing almost automatically, and a lot of that is flowing into the US. Now, with the policies of the US government, which is saying they want a lower dollar, which is, I mean, to put it bluntly, it's saying we don't need you and we don't particularly want you. Well, those flows are going to start changing pretty soon. I mean, if I was sitting in Britain right now managing money, I would think very, very carefully about allocating to the US. That's different for a US investor, perhaps, but I would think very carefully about certainly not allocating at the same levels that I have been allocating.
When you say that other foreign managers are less likely to allocate to the US, do you mean US equities or do you mean US treasuries? In other words, where do you see yields headed? And the
I mean U.S. assets in general, which
okay.
means the dollar, bonds, treasuries, and equities, as well as real estate, frankly. I mean, just U.S. assets in general.
I am curious how other central banks are responding to the trade war worldwide, and
Well, most of
ultimately
them are
how this
cutting, I think.
impacts, interest rate differentials.
Yeah, most of them are cutting, and that does make, for the moment, that makes the U.S., particularly the dollar, that makes the dollar more attractive, especially after the big cut, a big decline we've had this year. But the first time the Fed cuts rates, I think we're going to see that reverse, or I would suspect we'll see that reverse.
Okay, this is a question asked to Powell about what's going to happen next to Fed policy. Take a listen.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. We're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
I saw you crack a smile there, Adrian.
Well, no, I mean, poor old Jerome Powell. I mean, how clear can he be? I don't want to talk about President Trump. I mean, he's been pretty clear on that. Yet they keep trying. They keep trying. There was an interesting comment, by the way, if I may, on Bloomberg. What's his name? The brick guy, Jonathan Ferro, after the conference. He said, well, the press were doing their best to make it interesting, and Powell was doing his best to make it boring. And I think Powell won.
Well, remember a couple of weeks ago, up until a couple of weeks ago, Trump was doubling down on his anti-Powell rhetoric, at one point calling him a major loser on social media, Truth Social. And then miraculously, he made a 180 on media saying, no, he has absolutely no plans to fire Powell. Remember that? So
Yeah.
I wonder what happened there. Maybe the markets just threw a big fit because they didn't like
probably
the
Scott
uncertainty.
Bessent had a word in his ear.
Okay, maybe that. But going back to Powell's earlier point about not knowing what to do for the rest of the year, I think they're kind of stuck, aren't they? On the one hand, economists, even at the Federal Reserve, including the Atlanta Fed, are projecting a lower growth rate for the economy for the rest of the year, which should mean higher unemployment. But on the other hand, like the reporter pointed out, if tariffs are to remain, wouldn't that be inflationary? What they have to probably this is 2022 all over again, isn't it? On the one hand, you've got inflationary pressures, but then higher unemployment.
Yep. Well, no, as I say, I do have a little bit of sympathy for Powell, but I do disagree fundamentally on one thing, and that is everybody keeps saying tariffs are inflationary.
Okay.
Tariffs are not necessarily inflationary at all. Inflation is, well, inflation is misdefined these days, so let's not go there. But to indicate the measures of inflation, such as CPI and PCE, you can only have an aggregate increase in prices if the Fed has injected more money into the system. If tariffs do not create inflation unless the money supply is there to accommodate it. So, for example, if there's 100% tariff on my cheddar cheese from England, my real cheddar cheese, not the stuff from Wisconsin, and the price of cheddar cheese goes up, Well, if my income doesn't go up, I have to reduce my spending somewhere else. And if people in general reduce their spending somewhere else, then those prices will come down. So it's not inflationary. It's prices of certain goods going up. And so the way I would look at it is this, that the probability of the economy slowing, and therefore with it unemployment going up or the jobs market getting less strong, is more certain than the probability of inflation. Because if the economy slows in response to tariffs, and people will be put out of work. If I'm a store, I mean, to take an extreme case, but if my store sells British goods to Americans and the cost of my goods have gone up by 20%, you know that the demand for those goods is going to go down. And we've already seen some specialty stores, and it's not just Britain, I'm talking about Britain, but I mean, clothing, for example, all comes from overseas, most of it, whether it's high end or low end, whether it's Walmart from China and Vietnam and Malaysia, or whether it's, Gucci and Ferragamo and everything else. So we've already seen certain small stores either shut their stores down or reduce their staff or whatever. So we know that the impact on the economy is, we can be pretty certain the impact on the economy from tariffs is going to be very, very weak. It's going to be bad, at least in the short term. Now, if that's true and stores start laying off people and so on, you're not going to see inflationary impacts. Inflation, if anything, is going to start to moderate in the near term.
What then happens to gold? Let's move on to gold now. It fell 1.4%.
Yeah.
On the session. It's still hovering above $3,300 gold an ounce, rather. So let's ignore the 1.4% drop. A lot of that may have come from the strengthening dollar. Let's just ignore that for a minute and just talk about the bigger picture here. What is $3,300 gold signaling?
I think it's signaling that there's a lot of uncertainty in the world. There's a lot of volatility in the world. Let's not forget, gold is, among all this talk, gold is the one asset that really isn't or is not so volatile these days. So for someone wanting some stability, rather than Hong Kong stocks or British stocks or US stocks or long bonds or 10-year bonds or whatever, gold is offering that stability right now. So I think gold moving is a reflection of the uncertainty, the volatility, and frankly, people's concern about these things, including the US debt situation, which is very worrying. And so I think people who've been buying gold, including central banks, of course, but people who've been buying gold are buying it for defensive reasons for the long term. This is not a trade. You look at, for example, family offices. There was a survey of family offices that came out yesterday. Family offices have allocated less than 1% of their assets to gold. If you look at hedge funds were selling gold last month. So I don't know what they've done in the last couple of days, because they move in and out faster than the data is presented. But they're not the ones driving the gold price. The people driving the gold price are people concerned about the outlook and wanting some kind of fundamental protection. And I don't think that's going to change in the near term. And that's why all of the pullbacks in gold, I mean, you remember when I was on your show, well, you may not remember, I remember in December, I was expecting a pullback in gold. The reason we haven't had and I'm not the only one expecting a pullback, but the reason we haven't had any meaningful pullback in gold is because, the holders are long-term holders. They're not buying gold for a short-term trade right now. They're not buying it even for profit. They're buying it as a defensive insurance position. And there's lots of people standing on the sidelines who haven't come into it yet. I mentioned family offices, 1% in gold. Look at the GDX. Now, the GDX has had inflows this year. The GDX, which is the ETF for physical gold, they've had inflows this year. But, there's as many days with outflows as inflows. The inflows tend to be larger, but there's many days with outflows. And the other thing that's really important, you look at the GLD, even though the price of gold has gone up, the number of shares outstanding, that is a reflection of the flows, people buying and selling, the share count was far higher, even as recently as 2023. And of course, you go back to 2022, 2021, back to 2011 and 2012, we've had massive outflows in gold over the last few years. So, and the reverse of that, is true, but there's a lot of money on the sidelines, in my view, yet to be invested, yet to come to the gold, yet to buy gold.
Okay.
Whether it's retail investors, you talk to any coin dealer you want, and they all tell you that even if the phones are busy, the phones are ringing a lot, it's mostly people wanting to sell, not people wanting to buy.
Okay, I'm going to show you this quote from Larry Fink, and I do want to tie this to gold. But earlier in April, he said that America's rising national debt could threaten the dollar's status as the world's reserve currency, potentially leading to decentralized assets like Bitcoin taking its place. Ray Dalio echoed a similar sentiment about the debt situation. He said, if the U.S. doesn't get its debt under control, if deficits continue ballooning, America risks losing that position to digital assets like Bitcoin. Let's make this a two-part question, Adrian. The first is whether or not you agree with his general assessment of the debt situation. And second, would a similar sentiment be applicable to gold?
Yeah, yes and yes.
Okay.
Absolutely, I agree. And that's one of the US fiscal problem, which has been looming for years. Everybody can see it coming, and nothing is being done about it. I mean, Doge was an attempt, but in terms of the big picture, it's not being solved, and everybody can see it coming. So I absolutely agree completely. The U.S. debt situation is the most serious financial issue in the world today. And you can have a small country that has debt out of control, but we're talking about the country with the reserve currency. And so when you see the country, the nation that has the reserve currency have debt levels like this, people start to turn away from using the dollar for their reserves and for trade. And that's very, very meaningful.
Well, what would the concern be that the U.S. could somehow default on its debt obligations if debt gets out of hand? I mean, that's impossible now, isn't it?
Is what?
Would that not be impossible?
No, not impossible at all. You can default in many ways. I mean, the idea that you're going to force foreign official holders of US treasuries to swap their treasuries for 50-year non-tradable zero coupon bonds, isn't that kind of a default? If you're forcing people to swap it, if you're telling people, well, you know what, if you want to own our treasuries, you've got to pay us for the privilege. Isn't that kind of a default? But I think the bigger or the more likely in the near term, the more likely outcome is that just long rates move up significantly because there just aren't enough willing buyers of treasuries. We know Russia's not buying anymore. China's not buying anymore and is selling. I'm not saying they're dumping, but they're selling. We know even that Japan, that's been very friendly, they've stopped buying and they're on balance selling, again, selling at the margin. But, who's going to buy long bonds? And I've got an answer. The answer is the Fed. One thing, David, I mean, the press, I think, did an absolutely awful job at that press conference. You and I would have done a better job. Same old questions 15 times about Trump, about tariffs, same old answers from Powell. No one asked about the balance sheet. The balance sheet is just as important as interest rates, and nobody even asked about it.
What's happening with the balance sheet now, Adrian?
Sorry?
What's happening with the balance sheet now?
Well, as you know, the
Yeah.
Fed, nothing happened today, but the Fed has reduced significantly the amount by which they are reducing the balance sheet. So 2 months ago, I think 3 months ago, it was 35 billion a month, and it went down to 25 billion a month. And then last Fed meeting, it went down to 5 billion a month. 5 billion a month on a $7 trillion balance sheet is like a rounding error. You can hardly see it. So QT is basically over at this point.
Okay.
QT is over. The question is, when do they start QE? When do they start buying bonds? And I think that's coming soon. They may or may not call it QE. I'm sure they'll try to avoid calling it QE, but that's what it'll be. But QT is over. 5 billion a month is peanuts.
So you think that inflationary pressures will come from the end of QT regardless, even if the Fed doesn't lower rates? Is that too far of a
Correct.
stretch? Okay.
No, that's not. I mean, these two things both have effects. Yeah.
Sure.
And
Okay.
I think Powell has been very, I mean, we know this. He's been very, very reluctant to cut rates because inflation is not yet under control, and he's really focused on inflation. I give him credit for that. So he's been very reluctant to cut rates. President Trump telling him to cut rates only makes him probably stiffens the sinews a little bit. Makes him even more reluctant to cut rates. He couldn't cut rates in the face of Trump telling him to cut rates.
Yeah.
But he's been reluctant to cut rates anyway. But QE is another way of injecting liquidity into the system and supporting the long-term bond market.
The moment your interview with me airs, Adrian, if it ever makes it to Trump's ears, he's going to start telling Powell to raise rates. And,
Well, there you
and there's
go.
some reverse psychology going on there. And then maybe he'll get what he wants finally. Anyway, we mustn't forget also that the M2 money supply has been rising, to your point about the balance sheet. I know this is not the Fed's balance sheet, but I'm just making a point about liquidity in the U.S. If I were to make this an annual percent change, you can see that the M2 has been growing at 4% now per annum.
Absolutely, yeah. I mean, and this is what we see in a lot of statistics. This big shoot up at COVID, and then we not so slowly. We came back from those extremes, overshot a pendulum a little bit, as often happens, but now it's moving back up. Yeah, so there is liquidity in the system, and that's what allows inflation.
I'm going to finish on gold equities now. Adrian, this is a chart showing the GDX ETF versus
yeah.
gold year to date. Now, very different narrative from a year ago when the reverse was happening. Here we have the GDX outperforming gold by several percentage points, 12% actually. GDX up 40% year to date. Gold is up 28%. And if we were to overlay this with the S&P, you can see just how much of an outperformance this is, with the S&P down 4%. Now, last year when we were talking about this, it was the reverse when gold was kind of beating stocks. Gold stocks were chugging, just chugging along, not doing super great relative to gold. But now it's the reverse. And last year we were talking about how undervalued gold stocks were because they were underperforming the bullion. Can the reverse logic be applied now, Adrian? This year in 2025, can we say that gold stocks are now overbought?
No.
Okay, all right.
Well, a couple of things. First of all, you're showing this year, which is fair. You've got to start somewhere. If you look at the last 6 months, you get a completely different picture. Gold stocks and gold are both equal.
There you go. 6 months.
There's no outperformance. And so obviously the starting point matters. And I'm not picking an argument with you.
Sure.
That the beginning of the year is a logical place to start, but it does depend on where you start.
I see.
That's number one. The second point I'll make is that the outperformance we've seen, even this year, if you look at, this year, or even if you started
well, this is 6 months
middle
now.
of April, the most extreme case possible.
Okay.
We still have not seen the kind of leverage that you typically see in the gold stocks in the early stages of a bull market. We haven't seen that at all. I mean, if you go back to you go back to 1976, or go back to 1979, or go back to 2000, or go back to 2009, the gold stocks were up by over 100% in the first 3 or 6 months relative to gold up 10 or 20%. We simply haven't seen that leverage yet. So that's number one. Number two, valuation. I'm a value investor, so value means a lot more to me than price. And the valuations on the gold stocks are still very, very low. Let's not forget, David, but let's not forget that the price of gold, the product they're selling, has been moving up far more rapidly over the last 18 months than the cost of mining. All the mining companies on their quarterly calls are spending time talking about cost control initiatives and, this, that, and the other, and that costs were only up 3%. Whoop-de-doo, look at the price of gold. The margins have been expanding like crazy. And so if you take those margins and the free cash flow that these companies are getting, and then you look at the price of the stocks, you see that the valuations are still very, very solid. Barrick, I know people, you can argue with Barrick, they're switching to copper and they're in Pakistan and everything else. But Barrick is trading at almost its lowest price to NAV in its entire history. I would argue with gold at over 3,000, that doesn't really make sense. You look at Agnico, one of the more expensive of the senior gold stocks, and rightfully so, because in my mind it is without a doubt the best. It's the gold standard, let's put it that way, the gold standard of gold miners. But if you look at that and you look at their price to cash flow, it's still in the lowest 25 percentile of their 40-year history, right? Now, when gold's at record highs and the margins are expanding, typically you get valuation expansion, not contraction. But we're not seeing that this time. We're seeing lower valuations today than we were seeing 2-3 years ago. Doesn't make sense. So yeah, the stocks are still very, very cheap in my mind. And you only have to look at the flows. Look at the flows into the GDX. I mean, I've got it here. Let me just 3 billion in outflows this year from the GDX. And just in the last month, in the last 4 weeks, that is not a calendar month, in the last 4 weeks, we've had 750 billion of outflows from the GDX. So there's no mania on the gold stocks at this point.
Okay. Final question then. So given your outlook for gold miners, are you favoring the seniors or the juniors right now?
Well, I'm favoring all of them, but the seniors are always the first to move and the more certain to move. So I think at this point in the cycle, it's still right to emphasize the seniors. And that includes the royalty companies, but I think it's still right to emphasize the seniors.
Yeah, good. Thank you very much, Adrian. Where can we follow you?
AdrianDay.com.
Okay, we'll put the link down below, adrianday.com. Appreciate your insights. Thank you for reacting to the FOMC with us. Happy Fed Day. We'll see you next time.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.